How are U.S. government securities taxed? Have you ever wondered how U.S. government securities are taxed, especially if you are considering them for your retirement investments? Understanding the tax implications can help you make informed decisions. Let's break it down. U.S. government securities include Treasury bonds, Treasury bills, and Treasury notes. The interest income you earn from these securities is subject to federal income tax. This means you must report any interest payments on your federal tax return, and they will be taxed at your ordinary income tax rate. However, there is a significant benefit for those investing in retirement. The interest income from these securities is exempt from state and local income taxes. This can be particularly advantageous for investors living in states with high income tax rates, as it can improve your after-tax return. Different types of U.S. government securities have specific tax rules. For example, Treasury bills pay interest at maturity. Therefore, the income is taxable federally in the year you receive the payment. On the other hand, zero-coupon Treasury securities, known as separate trading of registered interest and principal securities, do not pay interest periodically. Instead, they accrue interest over time. This accrued interest is taxable each year, even though you do not receive the cash until maturity. This situation is sometimes referred to as phantom income. Treasury inflation-protected securities adjust their principal value with inflation. The increase in principal due to inflation is taxable as income in the year it occurs, even if you do not receive that amount until maturity or sale. If you hold U.S. government securities within bond funds, the tax treatment can become more complex. Fund dividends from interest on government securities are generally exempt from state and local taxes. However, the fund may distribute capital gains, which are taxable. Capital gains taxes apply when you sell shares of the fund or when the fund manager sells securities within the fund. From a retirement perspective, holding U.S. government securities or bond funds in tax-advantaged accounts like individual retirement accounts or 401(k) plans can defer taxes until withdrawal. This strategy allows you to avoid paying taxes on interest income annually. Instead, you will pay ordinary income tax only when you take distributions in retirement. To summarize, interest from U.S. government securities is federally taxable but exempt from state and local taxes. Special rules apply to different types of securities regarding when interest income is recognized. Holding these securities in tax-advantaged retirement accounts can defer taxes until retirement withdrawals. This tax treatment, combined with the low risk of U.S. government securities, makes them attractive for conservative retirement portfolios seeking steady income with favorable tax considerations.